Hi, I'm Ben Reppond. Today is April 26, 2023. Welcome to my YouTube broadcast. This is on my market insights. I'll be covering the metrics of the market. We'll start with the dashboard. This is as of last Friday, the 21st of April. I put in going down the list are the indexes, starting with the NASDAQ 100, the developed markets, the S&P 500, so forth, on down to the bottom. And then in the yellow box is the performance of these indexes last week. And then the pink box is the performance year to date. On the far right are the dots, green dot meaning above the moving average, or the red dot is below the moving average, the 20, the 50, 100, and 200-day moving averages. So you can see there's a lot of data here. And then I put a white line across the S&P 500, kind of in the middle of the chart. So you can see, it's very interesting. This last week, the market was mixed. Some aspects of the market were positive, some were negative. It was a little bit more on the negative side than the positive, but, I'd call it kind of a break-even kind of week. Year to date, there are two indexes that are definitely dominating, and that is the NASDAQ 100 and the developed foreign markets. After that, it drops down quite a bit, and at the very bottom is the Russell 2000 small cap index, which is up 1% for the year. The sectors inside the S&P 500, there are 11 sectors, and they're mixed. So you can see, and they go from the highest performer for the year, from the pink box, to the lowest performer. And in the yellow box, you can see that's what happened last week. In the yellow box, it's kind of all over the map. Again, a little more negative than positive, but, not by a lot. The two most negative components were the telecommunications sector and the energy sector, down 3% and 2%. Year to date, you have two at the very top, and then it drops way down. You got the technology, XOK, and XOY, which is consumer discretionary. Those were up 18% and 14% year to date. After that, it drops way down to 3% all the way down to a fraction of a percent, and then four of them are negative year to date. On the far right, you can see the dots. They're kind of all over the map. There's not a particular pattern. Some are above their moving averages and some are below. Again, I think there were a few more red dots than last week, but not by much. Okay, get to the charts. This is a weekly chart for the last 18 months for the S&P 500. So you can see it goes up and down a lot, right? But if you look for the pattern is where I drew the black line. The macro pattern is generally down, but the pattern for the last 6 months or so is up. So it's kind of two stories here. So I focused on, since last October, you can see the direction has been generally positive. When you break the S&P apart to the growth stocks and the value stocks, there's ETF for each component of the S&P. SPY G is for growth, SPY V is for value, and I put these in a relative strength chart, growth meaning the numerator, value denominator. So when it goes up, that favors growth. When it goes down, it favors value. So you can see I drew the black line, and it shows over this 18-month period of time, the general direction is down, which means that for this entire period, 18 months, it favors value. Value stocks are doing better than growth stocks. However, I put a red arrow at the end of it so you could see from the beginning of 2023, at least from a short-term perspective, so this would go for about 3.5 months. Short-term perspective, growth started to come back into favor, meaning it went up. But now you can see at the very end of that, it's trailing back down again. And so I don't know if that's a head fake or what, but the long-term direction is still favoring value. Large cap versus small cap. Large cap is the S&P 500, the 500 largest companies in the S&P in the stock market, and the small cap, which is the Russell 2000 small cap index, IWM, and I put those in a relative strength chart, putting SPY, the S&P 500, as a numerator, and IWM, the Russell 2000 small cap, as a denominator. So when it goes up, that's going to favor large cap, large companies, and when it goes down, it's going to favor smaller companies. So you can see, again, it goes up and down a lot. But at the very end of it, you can see for the last couple of months that large cap has surged way ahead of small cap. And then that changed a little bit this last week, the last week or two. You see that tick down. But I'd say the short-term direction is favoring large cap, and the longer-term direction is also favoring large cap. Treasuries. The long-term treasury bond, the exchange-traded fund, TLT, represents the direction of a 20-year government bond. And I drew two arrows here. One is for the last 5 months or so, the red arrow goes across, and you can see the value of the long-term government bond. It wants to go up, but it can't. It just goes up and down like that. So it's kind of directionless for the last 5 months or so. And then, excuse me, but for the long term, or for the 18-month period, I guess you'd call that intermediate term, the direction is still down. So meaning that yields, bond yields are up, which means interest rates are up, relatively speaking, because they track each other. And then the inverse of that is the price of the bonds, in this case, the bond ETF, is down. So they work in an opposite direction. The dollar continues to go down, and this started about last October, and it occurred about the same time that Saudi Arabia, China, Russia, and India struck a deal to buy oil from Saudi Arabia in yuan. And I don't know if that's directly tied, but it seems to me it is. So, but the dollar is weakening over that period of time. I think the general direction, and from everything I read, is that the dollar is probably going to continue to weaken. Gold, measured by the ETF GLD, you can see again, this is a 12-month chart, so you can see the general direction, a lot of up and down, but the general direction for the last 5 or 6 months has been up. And recently it had a tick down, but general direction is positive. Same with silver, general direction is up, but recent tick down this past week. When I put those in a relative strength chart showing the numerator is silver, SLV, denominator GLD for gold, it again goes up and down a lot, but you can see in the last month and a half how much silver has outperformed gold. But prior to that, for that, 3-month period prior to that, you can see how much gold outperformed silver because it went down so much. But that was not to last. Silver did come back and respond. Bitcoin, we track this with BITO. There are two ETFs, GBTC and BITO, that could be used. I prefer BITO, and I was using GBTC earlier, but feel that BITO is a better ETF for this purpose. And we have a Bitcoin model, and we got out of we went to money market this past week. We participated in quite a bit of this run, made quite a bit of money in that, and but had been in and out of the market a couple of times, got kicked out this last week, and are now waiting for the next opportunity to get back in whenever it indicates that. But so this chart is of interest to me because we've got money invested in that. Okay, volatility. The volatility index. A lot of this was kind of a little more negative than positive. It was mixed, but from the volatility standpoint, the volatility index was down, which favors a positive market. And you can see it continue to go down. I showed a black arrow. It does go up and down a lot, but the current direction of the market is definitely up, and the volatility index is definitely down. And I put my black mark at 24, which is my indication when things start to get more volatile. If it breaks above 24 moving up, that would signal increased volatility and probably downward pressure on equities. Asbury Research, with what I just said, and we saw the mixed bag for the market in the indexes and the different sectors, mixed for sure. But Asbury Research, all of their metrics, all 6 of them, are still positive. And they have been, I think this is at least the 3rd week, they have all been positive. So that's signaling positive indication, at least as of now, or this was as of Friday, for the market. Okay, the next chart from Asbury Research is the relative performance of assets and comparing one to the other. And when there's a strong enough indication of one over the other, it gets a green box. The columns go weekly, the last week, the last month, the last quarter. So fairly short-term period. The first one where all 3 are green is low volatility stocks. Low volatility would be more like value stocks, Dow type stocks, blue chips. That would be lower volatility. And that is more favored than high beta or high volatility. And that was reflected in the previous chart. The chart I showed was an 18-month period, including the current period, all showing value was more in favor than growth. And periods of growth that appeared only lasted for a short period of time, and then it went back to value. In a bear market like we're in, it's not uncommon. Large cap, again, we saw this when I showed you the chart where we were comparing SPY, the S&P large cap, to IWM, the Russell 2000. Clearly, large cap is in favor, and that shows up here in the last week, month, and quarter, more favorable than small cap. Developed markets, EFA is the ETF representing developed markets, definitely more favorable than the U.S. market. And the U.S. is more favorable than the emerging markets. So developed and emerging have kind of diverged here, and the U.S. is more favored. And nothing in the bond area that is strong enough of one versus the other to merit a green box. This is interesting. Now, this for a long time, the U.S. has not been had a green box on here. So this is mostly Europe, Japan, and Mexico. Europe, Japan, and Mexico are favored over the U.S. for the last week, the last month, the last quarter. Isn't that interesting? And what I did in the next chart was to show, it's a relative strength chart. I've been showing this for the last month. Relative strength showing France, nothing wrong with France, but, France is stronger. Their market, EWQ is a symbol, is stronger than the U.S. market by this much. Look at that black arrow for the last 6 months. That's how much stronger France is than the U.S. Said another way, I guess you could say that's how much weaker the U.S. is than France. But if we went to Switzerland or the UK, Eurozone, all of those are all similar. I thought the most pronounced was France. Okay, gold and silver. I showed you that it was slightly positive for the last week and maybe the last couple of weeks, or slightly negative. And gold is at $19.89 per ounce spot price as of last Friday, and silver is $25.19 per ounce, down 1.6 and 1.8% from the previous week. The gold-silver ratio is 79-1, still definitely favoring silver as a better value than gold. The Monster Box, 500 rounds, 500 ounces. So this data is from my son, Preston, and he's in that business, so he gives me this data. And you can see as of last Friday, the price for a Monster Box was $14,795. So if you want to buy a container, a tube of 20, you can do that, or you can buy 20 tubes or 25 tubes of, I guess it would be 20 tubes of 25 each, and for $14,795. I like silver, and so if you're inclined to buy it, those are the current prices. The markup over spot is down from its high of $5 per ounce down to $4.40. If you buy it in this quantity of a Monster Box, it's $29.59 per round, including the markup. If you buy it in a tube of 20 or 25, it is $30.09, including the markup. And I am a fan of buying silver over gold. I'm a fan of physical metal versus paper, and I'm a fan of buying it locally, if possible, from a brick and mortar retailer. And I give you these prices just for a point of reference, maybe a benchmark. So if you're buying some, you at least know kind of what the going price probably should be. Who controls our country? The White House, Congress, or the Federal Reserve? This picture gives you a perspective on where that might be. Thank you for watching. If you have questions or comments, leave them in the comment section below.